Thanks, Chrissy. I'm not sure I need to say anything more now, but I'll try. Okay. This is, I think, the third or fourth time I've been here, so hopefully many of you in the room recognise me and know me. I've grown a beard since last time, so that's probably the only real change. And tomorrow marks the first anniversary of my time as managing partner at risk, a job I'm really enjoying. We've got a great team, and I'm hoping to share some of that with you as we move through. So, as with all these things, everyone seems to show a disclaimer. Difference with ours is it's legible, and it says a few different things. So whilst you read that, I'll just also put in a personal disclaimer. I am not an explorationist, okay? So I'm actually an engineer by background. Whoops, let me go back. I didn't mean to do that. But I do know a lot of geologists and explorationists, and risk obviously work with a lot of clients. In fact, looking through the program, I can say categorically that risk works with most of the companies that you'll see presenting at this conference, probably more than 70% of them. And for those that we don't currently work with, I hope after seeing this presentation you'll realise what you're missing, and you will come and join the others as well. So that's it. I'm just going to put a bit of a different spin on exploration, as I'm not an explorationist. You'll see no seismic lines. I'm colourblind, so I don't know what they mean anyway. You'll see no maps, but hopefully it will give you a bit of an insight into how investment should be viewed in exploration. So I'm going to start off by talking about resources and how we describe them once we've actually found them, because just putting them well in the ground, there's still a heap of uncertainty. So we deal every day in uncertainty, and explorationists and even project developers, even people who are producing assets, producing assets deal with uncertainty. So the range we often describe in terms of probabilistic. So a P90 is I have 90% confidence that I'll have at least this much volume. P50, 50%, 50-50, it could be bigger, smaller. And P10, I've only got a 10% level of confidence that it will be this big. Okay? That's how they're described. And as you move through an asset base, that line tends to get a bit steeper, and you hope that it sort of tends towards that P50 or mean. The mean, or you often hear it called to our best expectation value, is often above the P50 purely because of the shape of this and the way probabilistics work. I can go into that in more detail, but it's another presentation completely. So that's what we get even when we've found resources, okay? So, but what about exploration? Okay, there we go. I'm going to talk a little bit about exploration. So let's look at it in terms of a volume that you might have against a probability of what you might find. And the first thing you get to here is a probability of success or a possibility of success. And I've just chosen a random figure. It's often somewhere between 0 and 30% in terms of exploration because of the nature of the prospects that people are looking at. And it's often termed a geological probability of success. I actually prefer to think of it as a geologist's probability of success because it's always someone who's come up with it, and they will always have biases in the way they look at things. But let's stick with the actual standard term, which is a geological pos. And then from that graph before, you remember? So there's a 70% chance that you won't find anything at all, okay? If you do find something, you've then got to overlay that figure that I showed, and I've turned it upside on. That's the same graph, which sort of says this is the distribution of the range of volumes I might find. And what you'll often hear in terms of the story is, this is our best expectation of the volume we might find. And sometimes you hear, it could be this big. And I think you've probably heard both of those this morning, and you'll hear them again this afternoon and tomorrow. They don't necessarily tell the whole story, though, because if you find something in that mean, or it could be this big range, chances are you've got a good project, and that's why it's coloured green there. What's probably more important in terms of understanding whether a project is going to go ahead or not is what happens if you get a downside outcome there. So towards the P50 and lower and a P90 range. And that's what I'm calling the corridor of uncertainty. That's supposed to be amber, that colour, by the way. I'm not sure if it is on this screen. Now, those of you who know cricket will recognise that that's not my phrase. The corridor of uncertainty comes from that great English cricketer, Sir Geoffrey Boycott, who amassed a lot of runs at a very slow rate in the 1970s and 80s, and then became a commentator on cricket. So apologies in advance to those of you who don't like cricket, but it turns out that exploration is a bit like cricket. So as a batsman, right-handed batsman, if you're bowling at leg stump to me, I'm pretty confident I can amass a big score. If you're bowling straight at leg stump all the time, it'll disappear over mid-wicket. It's a big way of getting runs. If you bowl at middle stump, P50 outcome, I'm still going to build a big score. If you bowl in this corridor of uncertainty around off stump, it's a lot harder because you're playing away from your body. You can nick it to the slips or behind to the keeper, or you might choose to leave the wrong ball and it knocks over your off stump. Turns out Mother Nature has a habit of bowling in that corridor of uncertainty, and we'll talk a little bit about that later on. I'm assuming, by the way, Mother Nature's a pretty straight bowler. She bowls straight, either leg stump, middle stump, off stump. When spinners get involved in the game, it's a lot harder, and we'll mention that a bit later on as well. So why is it important? Well, to do that, we have to look at what's the value prospect here. And so you see I've changed the scales here. I've kept the probability scale down there, and on this side now I've got a notional concept of value. Just don't worry about the numbers too much. It's the concept that I'm trying to get across here. So, of course, if you do drill that dry hole, 70% of the time you will do, then you're going to lose some money. But it's probably in the orders of single-digit millions, maybe 10 million, tens of millions if you're drilling offshore. And you're obviously drilling in the hope that you're going to find something. And if you find something, hopefully you're going to get that sort of result. That's the sort of figure that leads to the types of conversations that you've been hearing from the quadrant executives on Dorado. Solidly commercial at a P90 or a low case outcome. Awesome at a P50, I think was the words, and simply staggering at a high case outcome, a P10 outcome. That's exploration nirvana, if you can get it, okay? Unfortunately, it doesn't always happen like that. Dorado's is quite special, actually, and I hope they do really well with it. So it could be like this, where the P90 outcome is a bit marginal. It's going to lose you a bit more money. You're not sure whether you're going to go ahead. You're probably going to have to do some more appraisal, throw some more money at it to find out whether you want to do the project or not. And in certain outcomes, particularly large gas fields, which I'll talk a little bit about a bit more, you could actually find that there's a really strongly negative outcome, and that's something to be aware of. So with that in mind, let's have a think about what determines that value. And I'm not going to try and produce a complete list, but here's some of the things that you might be a bit familiar with. Obviously, the resource size. And I'm going to talk about 15 million barrels in a minute, which might make some people in the room sit up and others fall asleep. 15 million barrels in today's money is about $1 billion, so it's not to be sneezed at. But it depends on where and how much money you have to spend on getting it out as to whether it's going to be a good project or not. Resource quality, and by that the sorts of things I'm talking about are heterogeneity, how easy the reservoir is, how good quality the reservoir is, porosity, permeability, and also the composition of the fluids. Is it a dry gas with lots of CO2? We know some fields like that. Is it liquids rich? Is it good oil? Is it not so good oil? Location, and I think with location you have to think about both the geographic location, possibly even the geological location in terms of how easy is it to drill through the overburden. And of course jurisdiction. What's the tax burden going to be like on this project? How much money am I going to get versus how much money is the government going to get? And of course, actually the owner-operator, who is running the project, because that has quite a significant impact on what they view as valuable or not valuable. So I said I'd talk about 15 million barrels, and I'm going to mention a few fields now. First of all, I'll talk about 3 oil fields, all around the 15 million barrel marker. First one's Cliff Head. They're all local Western Australian projects, by the way. Cliffhead's about 10 k's offshore, just south of Dongara. Was sanctioned in 2005 on 15 million barrels. Still happily producing today. Good little project. 15 million barrels is also a number that corresponds roughly to the figure that Balnaves was sanctioned on in 2011. That's an Apache project. It's not producing anymore. And 15 million barrels is also roughly the size of the Egret oil field, which I think was found in the 1970s. It's about 13 or 14 kilometres away from the Ocker production platform owned by the North West Shelf Venture. And it's not yet been developed and probably never will be. So you see the same size field, a number of different aspects to them each. I would suggest that only one of those was actually successful. If you look at gas assets, Scarborough is now in the hands of Woodside. I think it was clearly in that corridor of uncertainty for ExxonMobil. With Woodside coming on board and ullage opening up in various LNG plants onshore, I suspect that it's moved a little bit away from this corridor of uncertainty more towards a middle stump element. So I'm hopeful about Scarborough, I have to say. I think it's maybe getting its day sometime soon. Browse has to be in this corridor of uncertainty. Browse is probably the one that I would say looks potentially most like this. You know, they've got to close to FID decisions twice now and walked away or walked backwards. I suspect that like me, there's a whole heap of people in this room who have been involved in concept selection studies on Browse, but I won't ask for a show of hands. That's probably rude. Moving further around Australia, you have Petrel Turn. Again, lots of exploration, lots of appraisal works done on it. It's still in the ground, sorry. Again, in that corridor of uncertainty. Last one I'd want to mention, again, it's one that's fairly close to my heart because I think there's been some really good things going on with it, and that's the Sole project in Victoria, offshore Victoria. Again, found by Shell in the 80s, was unloved for a long time. Santos picked it up some years ago, but it was only really when Cooper Energy got involved that it started to get legs again. Cooper have now got 100% of it. I think you'll be hearing from David Maxwell tomorrow. They've done some really good things in terms of getting other people involved, mitigating risk. They've just finished drilling their 2 wells, which apparently have gone okay. And I'm hopeful that's going to be on production sometime in the next year and a half or so. So, as you see, a whole range of projects in and around Australia that fit in that corridor of uncertainty perspective that I was talking about. Now I'm going to just change the focus a little bit and talk to you about why risk can help and why you should come to us. As I said, I'm not an explorer, but a lot of the people in the team are. We also have reservoir engineers, commercial people, PTs, and we get involved regularly in every stage of the project life cycle, from exploration through to operate. And when I say regularly, that's probably an understatement, because I would probably be right in saying that at least every week, if not every day, we're involved in a project, or more than one project, doing at least one of these things. So to give you some perspective, last month, if you remember, if you've been following the Santos story, you'll have noticed in small letters on a number of their slides, risk advisory there. So we're obviously helping out with the quadrant purchase, and that took a lot of our time. So we've been very busy in August and months prior, but it wasn't our only project. In fact, in August, we were busy on roughly 25 projects. Some of them involved single assets, but most of them involved portfolios. And when you add up all the assets in those portfolios, we were looking at 85 assets last month in various stages. I'm nearly done. It's all good. And annually, that's well over 100 projects each year and probably 500 assets. Some of the assets, in fact, many of them, we look at many times over a number of years. And I would probably say that in some circumstances we know more about the assets than the current operator does, particularly when we've just helped someone buy an asset. So we've got over 20 years' experience, over 2,000 assignments, 70 countries. I don't know how many assets that is, but it's a lot. And so we have vast experience and understand. And even if we didn't know an asset, chances are we'd have a really good analogy somewhere in our portfolio. 3 years ago, I presented our founder with the copy of the very first project report ever written. And whilst I can't guarantee that we can find all 2,000 plus assignments, I can guarantee that we can find about 90% of our reports over the 24-year period that we've been here. And that's pretty good going. That's some history that we have. So, go back to something that is a little bit like the disclaimer at the front, but I've put the first bit in bold. And going back to cricket, why should you have us on your team? Well, we play with a straight bat. Sorry. We don't have a vested interest in these projects. We're not investors ourselves. We are just oil and gas industry professionals who want to help people understand the real value of the assets that they're dealing with. And with that, we tell our clients what we think, which sometimes causes some hard decisions and some hard discussions. And finally, like all good batsmen, I think we've got a good track record. We don't make a high score all the time, but our average is pretty good. Thank you.